The the Credit Card Accountability, Responsibility, and Disclosure Act of 2009 mandated significant disclosure and substantive requirements for credit cards. Among the substantive requirements were restrictions on practices that credit card companies used to manage risk. These restrictions prompted credit card companies to raise prices, reduce credit limits, and limit availability of credit to riskier individuals. The reductions in availability of credit card credit may have stimulated demand for consumer finance credit, historically an important source of credit for small amounts to riskier consumers. For most of the 20th century, consumer finance loans are small, often unsecured, closed-end cash loans from licensed finance companies. For most of the 20th century, they were a major source of credit for riskier consumers. Their small size makes consumer finance company loans relatively expensive to produce. Costs are largely fixed and not very sensitive to loan size. Towards the end of the 20th century, credit cards became, for many consumers, a popular source for borrowing small amounts. Convenience is one reason for the spread of credit cards. Cost is also a significant reason. One origination for multiple credit advances allows credit card companies to provide small amounts of credit at lower rates than consumer finance loans. The general-purpose bank card has become the most widely held type of credit card. Once held mainly by higher-income, low-risk consumers, bank credit card holding has become widespread, also among higher-risk consumers. As mentioned, the Credit Card Availability, Responsibility, and Disclosure Act restricted several practices that credit card companies use to manage risk. Significant restrictions were limiting risk-based penalty pricing, that is, raising the interest rate when the account holder's behavior indicates greater risk. Capping initial rates or fees on new accounts, and limiting late and over-the-limit fees. Let me briefly describe the restrictions. Risk-based penalty pricing raises the interest rate on an account when the consumer's behavior on the account suggests credit risk has increased. The triggers invoke penalty pricing well before the account is 30 days late. For example, one penalty might be 2 times 5 days late or a return check on payment. Promptly invoking penalty pricing produces revenue to offset eventual losses, but also higher penalty rates stimulate prompt reductions in new charges and paying down balances on accounts. The higher rate provides a stimulus for customers to take actions to reduce default risk. Previous research indicates that bank card holders are sensitive to interest rates. They respond to higher rates by reducing new charges, paying down balances on the card with a higher rate, and after a year owing less on all card accounts. The Credit Card Act limits penalty rates to new balances unless an account is significantly in arrears and requires a 45-day notice before an increase becomes effective. Changing late fees and over-the-limit fees is another practice for managing risk. Card issuers charge steep fees to discourage late payments and exceeding credit limits. The revenue from these fees also help compensate for additional collection costs for late payments and the increased risk associated with large balances. Empirical evidence suggests that awareness of such fees is associated with greater avoidance of the fees. The Credit Card Act requires that the fees be reasonable and proportional to the violation and account terms. Implementing regulations also specify safe harbor limits for these fees. Finally, initial and periodic fees for deep subprime credit card accounts were large relative to the amount of credit line before the account. For example, a deep subprime account might have a $300 credit line, a $20 processing fee, and a $75 annual fee. available credit would be $205. The large fees and low limits left little availability credit to an account opening, limiting potential losses on risky accounts. According to industry sources, a considerable percentage of accounts charged virtually all the initial balance or credit and defaulted within the first 3 months. Consumers who paid the fees revealed themselves as creditworthy, albeit at an elevated level of credit risk. The Credit Card Act limits fees during the first year to no more than 25% of the initial credit line. A few studies have examined effects of the Credit Card Act. The Consumer Financial Protection Bureau reported that between early 2009 and February 2010, interest rates on bank card accounts increased and fees decreased. The Bureau also reported that credit became less available. Solicitations for new accounts, credit limits declined, with subprime consumers experiencing a larger decline than prime consumers. The CFPB noted that some of the effects were intended. Lower fees, fewer account originations among students, and rejections for insufficient income were lower, for example. Otherwise, the Bureau stated, where we observe substantial changes in issuer and consumer behavior, the question remains whether such changes constitute a response to the Card Act or a response to significant financial upheaval taking place at the same time. Giambaldi and Stavins used data from credit bureau files and from consumer surveys. They observed that account closures accelerated after the Federal Reserve adopted credit card restrictions to the ones that a few months later would be included in the Credit Card Act. They also found that terms of credit card accounts became tighter between the passage of the Act and the effective date of the rules implementing the Act. The results suggest that issuers began to adjust their card programs in anticipation of the rules taking effect. They also acknowledged that because the Federal Reserve's restrictions and passage of the Credit Card Act occurred during the recession, isolating the effects of the new law from those of the recession was difficult. Agrawal and others examined account-level data from 9 largest bank card issuers. They compared consumer accounts with small business accounts, that was their comparison group, which were not covered by the Card Act, and this helped them identify effects of the Act. Relative to small business accounts, they found little evidence of increases in interest charges or reductions in credit limits after the Act was passed or became effective. Whether they effectively distinguished between Card Act and recession effects is unclear. Their pre-log period included the recession and the Federal Reserve Board's adoption of credit card restrictions similar to those in the Card Act. Both the recession and the board's restrictions may have stimulated card issuers to raise rates or reduce availability. Also, it is unclear whether the small business account is comparable to consumer account, except for being subject to the Credit Card Act. A Federal Reserve report on small business accounts indicates that there are both similarities and differences between small business and consumer accounts. Lastly, Han, Keyes, and Lee examined survey data on credit card solicitations. Solicitations are an indicator of supply. In the pre-law period, the likelihood of receiving an offer was high, also for higher risk consumers. The likelihood of receiving an offer declined for all consumers in the implementation period, but the decline was greater for higher risk than lower risk consumers. 8 months into the recovery, after the law became effective, solicitations of lower risk consumers nearly returned to pre-law levels, but solicitations of higher risk consumers remained at recession levels. For our study, we examined the number of bank card and consumer finance accounts at state aggregate level, that is number of accounts per 10,000 customers, and individual level, number of accounts per consumer. The data are from the Equifax, Federal Reserve Bank of New York, Consumer Credit Panel. We look at 3 periods, The pre-law period ends with the Federal Reserve Board's adoption of credit card restrictions. An implementation period follows a board action. The effective period begins when all provisions of the Credit Card Act are effective. Each period is 7 quarters long. We rely on creditworthiness, that is whether a borrower is non-prime or prime, and the height of the consumer finance rate ceiling, low or high, to identify effects of the Credit Card Act. How do creditworthiness and consumer finance identify effects of the Act? As mentioned, the Credit Card Act imposes significant restrictions on practices issuers use to manage risk. Prime consumers largely did not become seriously delinquent and generate credit losses, nor do they engage in behavior that causes firms to incur collection costs. In contrast, non-prime consumers' borrowing and payment behavior suggests high-risk firms would incur elevated collection costs and loan losses. Thus, we expect the Act's restrictions would affect primarily non-prime consumers and have little effect on prime consumers. Turning to consumer finance loans. Consumer finance loans consist in large part of closed-end cash loans at finance companies, but this category also includes some sales finance credit. Credit bureau files do not include interest rates, but information from a database on closed-end personal loans from an industry trade group indicates that few such loans have interest rates under 18%. As bank card interest rates averaged around 12 to 13% in recent years, consumers who have a choice between consumer finance and bank card credit may well prefer bank card borrowing. In other words, consumer finance loans would be an expensive substitute for credit card credit. Evidence indicates that low rate ceilings reduce availability of consumer finance loans to riskier consumers. The National Commission on Consumer Finance came to this conclusion after reviewing evidence from its staff analyses in 6 volumes and from numerous academic researchers. Subsequent studies of rates and availability also support this conclusion. Because of their low risk, prime consumers would largely not be constrained by rate ceilings. However, because of the relatively high cost of consumer finance loans, prime consumers would be less likely than non-prime consumers to use such credit. Non-prime consumers often use higher rate credit, but as mentioned, rate ceilings likely limit availability of such credit to riskier non-prime consumers in low-rate states. We'll look at 3 measures to discuss the effects of the Card Act. First, we look at the number of bank cards per 10,000 consumers by creditworthiness and consumer finance rate ceiling. This is shown in the chart on the right of the slide. The blue bar is low-rate prime, orange is high-rate prime, gray is low-rate non-prime, and yellow is high-rate non-prime. Prime consumers had more bank card accounts per 10,000 consumers in the pre-law period. The difference can be attributed to credit risk. The number of bank cards should not and does not vary by height of the consumer finance rate ceiling. The number of bank cards per 10,000 consumers declined significantly in all groups during the implementation period. The regression that began in the pre-law period continued into the implementation period. The declines can reasonably be attributed to both the recession and implementation of the Credit Card Act. Bank card holding did not recover to pre-law levels in the effective period, which began 5 quarters before the beginning of the effective period. All right. Next, consider consumer finance companies per 10,000 consumers, which is shown in the chart on the left. Non-prime consumers in high consumer finance rate states had the largest number of accounts, of consumer finance accounts, in the pre-law period, 6,000 per 10,000 consumers. Non-prime consumers in low-rate states had about half the number of consumer finance accounts than non-prime consumers in high-rate states. As pointed out earlier, evidence suggests this difference is a consequence of reduced availability of consumer finance loans due to the rate ceilings. Prime consumers had the lowest consumer finance loans. This result likely affects demand for consumer finance loans, as demand for consumer finance loans is relatively expensive and lower credit alternatives are generally available to prime consumers. All groups had fewer consumer finance accounts in the implementation period and effective period, reflecting household deleveraging that began during the recession and continued in the recovery. If we look at number of accounts relative to the pre-law period, possible effects of the Credit Card Act may be observed more clearly. First, declines in the number of bank card accounts during the implementation period were substantial for both non-prime and prime groups. That the difference between non-prime and prime groups was so small suggests that much of the decline can be attributed to the recession. The number of bank cards for non-prime consumers declined further in the effective period, about two-thirds of the pre-law level. In contrast, the number of bank card accounts for prime consumers remained nearly at the same level in the post-law period as in the implementation period. As the Credit Card Act restricted risk management practices, the effective period decline in non-prime but not prime accounts may be attributed at least in part due to the Act. Turning to consumer finance accounts. Consumer finance accounts of prime consumers declined to about half of the pre-law levels in the implementation period and remained at those levels in the effective period. This change can be attributed to deleveraging prompted by the recession. Rate ceilings did not matter because prime consumers' lower risk made them unlikely to be rationed. Consumer finance accounts of non-prime consumers also declined during the implementation period, again, likely due to the recession. The decline was smaller for non-prime consumers in high-rate states, 75% of the pre-law level, than in low-rate states, 64%, consistent with low rate ceilings restricting availability of credit to higher-risk consumers. Despite small declines in non-prime consumer finance accounts in the effective period, non-prime consumers continued to rely more heavily on consumer finance credit than prime consumers. That non-prime consumers relied more heavily on consumer finance loans, particularly in high-rate states, suggested higher-risk consumers may have substituted consumer finance loans for subprime credit cards in the wake of the Credit Card Act. Finally, we present results from regressions predicting the number of credit card and finance company accounts per consumer. We include 12 dummy variables indicating the period, pre-law implementation, and effective periods, credit and the creditworthiness of the customer, prime and non-prime, and consumer rate finance ceilings, high and low. Our reference group is pre-law prime borrowers living in high-rate ceiling states. Other explanatory variables are age and income and unemployment. These variables account for demand, age and income, or total economic conditions, income and unemployment. We include quarter and year fixed effects. The regression results are much the same as earlier results. Declines in bank card holding in the implementation period were much greater than for non-prime than prime consumers. The declines continued into the effective period for non-prime consumers but not prime consumers. Non-prime consumers in high-rate states had more consumer finance accounts than non-prime consumers in low-rate states, likely because low-rate ceilings restrained availability. Non-prime consumers in high-rate states had more consumer finance accounts than prime consumers, likely because finance consumers had access to low-rate credit. Consumer finance accounts fell least for non-prime consumers in high-rate states during the recession, which occurred during the implementation period, and recovered some of the loss during the effective period. In contrast, consumer finance accounts of non-prime borrowers in low-rate states fell sharply during the recession and remained at low rates in the effective period. Again, non-prime consumers' heavy reliance on consumer finance loans in high-rate states is consistent with higher-risk consumers substituting consumer finance loans for credit card in the wake of the Credit Card Act, when consumer finance credit was available to them. In sum, our findings suggest that the Credit Card Act likely reduced bank credit card availability for higher-risk consumers. In addition, we find that non-prime consumers relied more heavily on consumer finance loans after the Credit Card Act in states with high rate ceilings, perhaps as a substitute for bank credit. Why should we be concerned about credit availability? Economic theory demonstrates that higher-risk consumers may benefit through greater household investment when unsecured credit is available. This finding from economic theory may explain why credit availability has for so long been a major issue in regulatory policy. Progressive reformers early in the 20th century advocated regulations that would increase availability of credit to working-class consumers. The National Commission on Consumer Finance in the early 1970s studied extensively the effects of regulation on credit availability, and availability continues today to be prominent in policy discussions, like discussions concerned with the Credit Card Act. Thank you.
Thank you very much, especially for hanging out the whole day. Thank you for sticking around. Thank you for the opportunity to present and our research. And yes, before I get further, let me point you to the bottom of the slide and point out that this research is the opinions of the authors. And since I have a co-author, Mark, at the board and a co-author, Benjamin, who's over at the OFR, I get to make a broad statement. It's not this is not opinions of the Treasury, the OFR, the board, or, people at government generally. And that after I've said that, I'd like to thank, I guess, even in the pre-conference, we got feedback on trying to push a little more on the modeling and trying to make a broader statement on what we find or try to explain some of our results a little more robustly. And so we've tried to make efforts there, and so we thank you for those comments. Okay, so actually let me back up and actually differentiate from the prior discussion was about credit cards. I'm going to be talking about debit cards. So I'm not sure how many of you guys use your debit cards. I don't at all. But this is a different regulation affecting a different product type. So just to differentiate that off the at the start here. Wow, the formatting really changed. Okay, so what we'd like to do is to, like I said, we've got pushed about trying to make a little more comment about what is the level of competition, what's happening in the retail banking industry, and we can make these comments trying based off our natural experiment. So when you look at retail banking, you would think, well, it's actually a rather homogeneous good, right? You can get a credit card at, pretty much most banks. You could get a debit card at pretty much any bank. The other category or characteristic we have of this industry is that we have a lot of firms doing this, and they offer many products, and many of these products are bundled, right? And so we're going to use this bundling idea to talk about competition. So we're going to use this natural experiment with debit cards to try to understand competition in the industry. Debit cards have grown very substantially. They're the biggest non-cash retail payment, and they've been growing, as I just said, quickly in the past decade or so. The Durbin Amendment of the Dodd-Frank Act is what is causing a change in this debit card market. So it cuts the interchange fee, and I'll discuss that a little more, but essentially halves it, right? So it was about 44 cents before the Durbin Amendment came into play, and now it's 24. But what we'll be able to use a difference in difference strategy as well, because only some banks were affected by this Durbin Amendment. Specifically, bank holding companies above 10 billion. So we'll have those banks as being treated, and then the banks below as being untreated. So what we find, jumping a little ahead to our results, or I guess kind of foreshadowing it, if the banks treated by this cap were able to offset the loss of this interchange fee, this would suggest that these treated banks must have some kind of market power, and as well, there must be a close relationship between debit card services and wherever they can offset that fee. Okay, so as a setup, I want to roll into actually the model that we're going to be using to kind of explain or describe our results, based off of again this bundling idea and this switching. So we could think about customers that are going to buy this bundled product when they enter a relationship with the bank, right? So they're going to get both debit card transaction services as well as their deposit account, because while you can separate those two, it's rather challenging and maybe not very pleasant for a customer experience. And so now we're going to write up a utility function that is going to focus in solely on this relationship between debit card, C, debit card, and deposit account services, D. And we're going to assume that they have this constant elasticity between these two goods. And so that's kind of the standard formula that we have for that relationship, where sigma is the elasticity of substitution. And then we're also going to talk about switching costs. So as a customer is thinking about their bank, and if the bank is going to change their products or change their pricing, then they could also just leave the bank, right? We discussed that in the industry, there are a lot of banks offering essentially the same good. So if a customer suddenly does not like what the menu of goods that a bank is offering, then they could switch, right? So given the setup where a customer can ultimately switch to another bank, the bank is going to realize that in their setting of prices. So the second function is essentially holding this relationship, right? So a bank is going to decide when they're trying to maximize their profits, right, and setting their prices for both credit card debit card services, and deposit services, they're going to be cognizant of this switching phenomenon, and so they're going to make sure. So the left side of your formula, they're going to try to charge, try to get as many profits as they can while keeping the customer, versus if they change their prices a little more and a switching of the customer, right? And the switching cost is that the income lost. Okay, so that's the bullet. So the bank is maximizing their profits. And so one reason that the current bank that the customer is dealing with can charge higher prices is because of these switching costs. Okay, so now let's think about the Durbin Amendment. What happens there? Well, now debit cards, that pricing function is capped. So no longer can the bank both use debit card prices as well as deposit prices to maximize their profits. They now can only use deposit prices, right? Because now the Durbin Amendment essentially has capped what they can do on the debit side. And so now they're trying to maximize this only with the price of deposits. That's what the PD stands for. But meanwhile, they're still thinking about this same switching phenomenon that they know that the customers can do. Okay, so what does that look like computationally? The blue line here, so we just do computational results of this. The blue line is what the bank would do pre-Durbin, so they have full flexibility of prices on debit card services as well as deposit services. And so since they're, in our assumptions, they have perfect price discrimination, they can capture all of the profits, the whole, no matter what the elasticity of substitution is. That's the x-axis. So even as the customer really does not want to, separate these goods, really likes to have a set ratio, they maintain the same prices. Meanwhile, the second best profit, so this is the green line, under now where the bank again is constrained, can only change one price. They're going to, when it's easier, the customer is very willing to substitute it away, they will lose profits in that setting. But as the customer is more inelastic in their substitution, the bank is then able to capture more of the profits, to the extent that if there is zero elasticity, they capture all of the essentially all of the switching costs, because that 4 is essentially the switching costs in this computational analysis. So what we're suggesting is, and I'll go through now the empirical results. The fact that we see that the bank was able to capture this amount, and it seems to be equivalent to the switching costs we see in our empirical analysis, it does appear that there is, this is possible essentially again with these two factors or two characteristics of the market. It's when banks have some kind of market power here by switching costs, and there's also a relationship between the bundled goods, right? So this is this elasticity of substitution. Okay, so what are we going to do in the actual empirics? Again, we're going to use a difference in difference identification. So again, banks above 10 billion are affected by this rule, banks below are not, and then we have the implementation of this rule. And I guess to harken back to some of the earlier comments to Jill and others, one of the nice things about our natural experiment here is there is really no incentive to move early on this. The bank loses revenue, so there's no incentive to move early. Moreover, the rule writing process was rather contentious, let's say. So the proposal was actually much harsher than the final rule. There was a lot of lobbying on this, and the final rule came out pretty close to implementation. So this is a nice shock from a researcher standpoint. Okay, so the key results are that we do see that interchange income falls, and so that tells us a couple things. Well, A, that if we didn't see this would be really shocking. The law didn't do what it was supposed to do at all. B, it also confirms that our data are good. We were able to measure this. And C, it tells us some kind of benchmark of what the banks needed to do to offset the size of this revenue loss. When we look at higher income levels that include interchange income, but then also essentially grab other revenue sources, we find the measures are about unchanged. So such that there must be some kind of offsetting thing by the time you get to that aggregate level. Our third result, we do see that deposit fees increase, and so this is essentially the offset where banks are able to mitigate this loss of revenue. Kind of another proof of this mitigation, if we add deposit fees and interchange fees together and look at those effects, it looks like they're about unchanged. So essentially, it's nearly complete mitigation is what we're finding in this test or examination. So we're going to use call report data, so the bank level data. And one of the reasons we do that is while the law is implemented at the bank holding company level, we care more about the retail banks because those are the banks that are using debit cards, and so that's where you would likely see actually the mitigation of the rule. We'll use quarterly data around the time when this rule gets implemented. We do a test for a common trend for the difference in difference analysis being acceptable. The board did list the banks that are covered by the rule, so we can use that to very clearly identify which banks were treated by the law. And we're going to essentially use kind of two types of panels. So we're trying to do this mix of, you really want to know, you want to kind of have a consistent set of panels, or sorry, consistent set of banks to really know where, if you have a regression and another regression and two different bank groups, you can't really connect the two. And so we use this consistent banks panel to be able to say something about across regressions. But we also lose banks to the extent that they have missing data or what have you. And so our individual panels try to maximize the observations and look at it that way. So our estimating equation is a straightforward difference in difference, if you're familiar with this. And we've now seen a couple papers on this. Essentially, you're going to look for banks that are, we have that triple interaction, or I guess double, the Durbin Amendment coming on board and whether or not you were treated. And so that interacted term is the one we care about. So these regression results, actually, how am I doing with time? Pretty good, I think. I think I have time for this slide. So this is a quick, like really dirty difference in difference examination. I know there's a lot of numbers on the table, and it might be hard to see in the back. But what I'd like you to, I guess, focus on is the top row and the far column. And so that's the quick, rough and quick and dirty difference in difference, because you're differencing between the untreated banks and the treated banks, and then post-law and pre-law. And you see that right there, negative, we have a loss of interchange income. If you now draw your line 2 lines down to total non-interest income, so now you're thinking about like where all the sources that a bank could potentially offset from non-interest at least, there you see 0.021, so roughly zero, not a big difference. We don't have any significance at this point, but so it looks like there's maybe offset somewhere. And where some of that offset might be is deposit fees, the next row after that, so 4% in that. Let me just move on and actually do the more rigorous estimation of effects. So here we're going to be regressing interchange income. So again, this is the fee that's going to get capped, the revenue source that's going to get capped at the treated banks. And as expected, the coefficient of interest is the interaction. In both the consistent panel in column 1 and the interchange panel in column 2, we do see a significant decrease in interchange income, so a 33% decrease in income. Thank you. Okay, now we're going to again look at higher aggregations of income to see if there are other ways that the banks essentially offset and to see what maybe, I mean, when we started this, we thought maybe about try to think about profitability considerations, right? So other non-interest income is a category that includes interchange income as well as other revenue sources. And we still see that the treated banks after Durbin, that top coefficient, those are still negative. So there's still a decrease even when you kind of look at, you capture other revenue sources and other non-interest income. But when you go to total non-interest income, these are columns 3 and 4, again in these consistent panel and the total non-interest income panel. Now we see that, statistically speaking, these are not different from zero. So it looks like somewhere that the banks were able to mitigate this rule. Okay, so as suggested before, deposit fees were likely the choice. And not only, it's not like we miraculously chose deposit fees, the banks were actually saying that they would likely use that as one of the tools. So the research is essentially also reinforcing what the bank said. The first two columns, log deposit fees, the treated banks after the Durbin increased their deposit fees roughly 15% to offset essentially this effect of interchange income fees. And then columns 3 and 4 do this aggregation that I talked about before. Just add deposit fees and interchange income and see if they are about unchanged, and they are about unchanged. So statistically speaking, they are not different from zero, according to our tests. All right, so summary of results. So we find the interchange income falls about 28%. For treated banks. When the 28% comes when we do the units properly from the coefficient in the earlier slides. We do see insignificant change in total non-interest income. We see that deposit fees do increase to essentially offset. And so another kind of estimation of this offset is summing deposit fees and interchange fees. The other thing that we look at is to see if customers do seem to switch banks, right? So there is a call item that looks at deposit accounts, and so we try to see if it looks like the number of accounts change from treated banks to untreated banks, and we don't find a statistical relationship there. And so then we could do this back of the envelope kind of rough estimate of what the switching costs might be by implication of the model that I presented before and the related costs. So if we use kind of some simple assumptions about a discount rate between 4 to 7% and about 100 average size debit card transactions, we're looking at a switching cost of about 175 to 310. And that's roughly in line with perhaps what you've seen in some marketing material. If you open an account now, we'll upfront pay you something. So banks often offer these types of incentives for you to switch, and so that we find that this range of estimates is actually rather reasonable. So some other work that we do in the paper, we look at some different samples, looking at low competition as a control panel, so banks that don't compete as much with the largest banks that were affected by the rule. We focus in on the asset thresholds, and the results still stand. We also look at whether or not the banks had other offsets on the expense side, and we don't see anything there. Did they change their branches or employees? We don't see anything there. And we also look at the tendency to avoid the $10 billion asset threshold, and right around the implementation of Durbin, we don't find anything there. And that is it.
Greg, come up and hang out with us. Let's take some questions, and Alan, start us off, but wait for the microphone, please.
I'm right there.
Thanks very much. I really enjoyed the papers. Cindy, I have two suggestions for you. One is you mentioned deposit fees, but you didn't mention deposit interest rates. Those are kind of fungible as to whether you charge a fee or pay a lower interest rate. You might want to check that. And the other bigger suggestion is I would suggest at least a robustness check, drop the bank fixed effects, and interact the key factor, the key variable with the HHI, the deposit HHI for the bank. So you're working on an assumption as to whether all banks have sort of equal market power, but there's plenty of research that says that the banks in markets with high deposit HHI have much more market power. So you might find much stronger results for those markets.
Thank you. Let me take the first comment first. We're in a low rate environment. I don't know how much you get on your deposit fees, or sorry, on your deposit account, but there's really not a lot of room to test there. We would have liked that to do that. On the measure of market power would be interesting, and so we could look at HHIs for different markets, because I don't know if you'd want to. Are you suggesting for the whole nation?
Well, you can do for each bank. You can use their average local market HHI.
Okay.
I do it all the time.
Okay, thank you.
Krista, please.
Hi. So, Cindy, both papers very interesting. Cindy, is a key takeaway from your paper that banks, as a result of the Durbin Amendment, didn't really hurt because they've been able to find ways to actually make up for the lost income, whereas consumers are really the ones who are hurting because they now have to pay more in terms of deposit fees, because it's only, and the merchants actually seem to be the winners because they have to pay lower fees to the banks, and it would only be in the case that the merchants actually pass on this benefit to the consumers that actually nobody is hurt. But now it seems that the merchants are winning, consumers are losing, and the banks, the ones that they actually try to affect, they're not losing at all.
Yes, you're capturing, exactly what happened. So some of the backdrop why this rule was very contentious was it was essentially a fight between the merchants who are effectively paying this interchange fee and wanting to not pay as high as a fee for something like a debit card, which essentially is the same. If you could think about it, it's very similar products or very similar characteristics to a check. And so when you write a check, it's cleared at par, right? It's cleared at the value of the check. But a debit card, the merchant has to pay this merchant fee, and so that was why they were lobbying for a cut of this fee. It's unclear. It's very hard to measure. I know researchers have tried to look at whether the customer has been able to, I guess, effectively get lower price increases or actually price decreases, but with the data available, it doesn't look like, it's very challenging to measure that. But at least from our paper, the banks were able to offset it, so it wasn't, the cost was not shoved onto the bank.
Just to follow up on that, so I'm not sure whether the banking customers were harmed, because another way to think about it is that if you tell banks that they can't charge, suppose that these two products, the checking account and the debit card, are stapled together. Now, of course, not everyone's identical, not every consumer is identical, but let's just go with the representative consumer model for starters. You tell people that they can't charge on the debit card side, but now they can charge more on the overdraft fees. So it seems to me that if there now were, let's say initially, that you're getting more revenue from these bank customers, then other banks would be willing to compete away with some kind of offers, which you alluded to, so that it seems like in equilibrium, it's really going to be more of a distortion depending on how much you as a consumer use debit cards or checking accounts. That's just my guess. Well, but I'm assuming that's zero. What do you think of how much the banks can compete for the relationship?
Yeah, there's a lot of ways to go with this. So one thing is that many of the banks cut their rewards program. So that, I guess, is another way that the customer lost out. To the extent that the customer is paying more in deposit fees, perhaps there's an offsetting price in the consumer setting. The other, I guess, other caveat that I would say is that it's somewhat challenging to compare large banks offering the products and then small banks offering products, because maybe one of the reasons you like a larger bank is because you really like a branch network that you have access to. So there are other services that we're not really pricing into this testing. We're kind of really narrowly identifying between this switching, and so I think the proper caveats apply there.
Well, we have lots of hands up, but any question for Gregory first? Yes, over in the side.
So I had 3 questions. I'll only give you 2 that are related. But the first one is, in looking at the information, as this is implemented at a federal level, it was implemented with much more of a fuzzy line policy by the CFPB than it was in the prior state regulations that were more bright line. Did you notice anything interesting in there? And then also, there were several changes in FICO scoring that came along during that time. Did you notice anything there that would bear on your results?
The FICO scoring and the credit bureau's proprietary models, they basically rank order. And while the model is basically updated on a regular basis, and so we have prime and non-prime categories. It's not our results aren't sensitive to where we draw the line. We could start at subprime or leave or start for the prime at some higher level. That would probably make the differences even greater.
And then how about on the difference between state level and federal level?
I'm not sure I understand your question.
So a lot of what was implemented in the CFPB and the enabling legislation for that was directly taken from proposals that were decades old at the state level, but they moved them to the federal level to get uniformity. But in doing that, they also changed it from the state level implementations, which were largely bright line, heavily litigated, very clear to institutions, to a fuzzy line approach that the CFPB encouraged, and they said, hey, we're going to file an action first, and then we're going to tell you what we really think. And I'm wondering how much of that was going on here.
I don't think that's much of an issue here. We're talking about specific practices that banks were using prior to the law, and they continue to use on a much more restricted basis now. And the law is very specific about what they can and cannot do. And basically, what has happened is that they have to set standards higher because they can't manage the riskier accounts profitably under the Card Act restrictions.
Bob, over here. Am I allowed to speak without a microphone? No.
Because we were recording.
Greg, you documented nicely that subprime customers lost access to credit. Are you able to tell us anything about the implications of that? Because, of course, some might argue that subprime customers shouldn't have access to credit.
First of all, most consumers, including subprime consumers, can reasonably pay their bills, and they reasonably do. Even in an extreme case, this might be with the deep subprime credit card accounts. 2/3 of them did not end up being written off. There was a 1/3 that I mentioned in my presentation who charged up to the limit and defaulted within a very short period of time. There's another 1/3 that basically paid off as promised over a period of a year or two, and they ended up getting better off for credit cards. And then there's this middle third, which chronically has late payments and entails collection costs, but they do settle up and become current. And they also tend not to be written off. And so these people pay higher fees for late payments and so forth, to the extent that the credit is available at all to them. But they also gain the benefits of having line of credit, even if it's a small one.
Questions? Alan? Wait for the microphone.
One more thing for Cindy, I forgot to mention this. I think you can say safely that your results are understated, and the reason is there's competition between the banks over $1 billion, over 10 billion, under 10 billion. So you're forced to assume that there's no effect for the banks that are under 10 billion, but in fact there is an effect because they're competing with the larger banks for both the interchange customers and for the deposit customers. So you can just say, nothing you can do about it, but you can say your results are probably stronger than they're indicated.
Okay, thank you.
Well, before we close, and we're going to close early, I want to make a couple of quick comments, because I've been impressed by all the papers, but I do want to emphasize in this last session things that I find particularly striking. With respect to Cindy's paper, I don't remember ever seeing a paper that showed how competition works within across relationships across products within relationships, and that found such a clean result, this sort of $4 billion, as I remember, going back and forth from one thing to another. I think that's really cool. Of course, I'm a geek, but I think that's super cool. And I also want to point out how much Gregory's results are changing the current consensus of the academic literature. Now, he uses lots of conditional expressions. I think they teach you to do that at the Federal Reserve. May, might, all that. But if you go and look at what's the current status of this literature, it's an article published in, I think it's 2009, in the QJE, which he referenced. Maybe it was 2012, I can't remember. And that article makes a mistake. And the mistake it makes is very similar to what Jill started us off with earlier today, which is a mistake about when a regulation becomes effective. And this is a very important correction. Jill, you don't have to correct the mistake because you're the first article to have done the work in that area. But I think it's fair to characterize what Gregory and his co-authors doing as correcting a mistake that has exactly this. So I think that's a nice connection between the papers. Neither of you has to respond to those compliments. And I think that I want to end by thanking some people, thanking all of you for coming and staying. I want to thank the authors for these papers. You know, this is when I started off doing this, I really wasn't sure that it was possible to assemble such a good collection of papers and to commission people to write them and to pull them together. And I'm just so impressed, and it's a great source of optimism about the future of the work in banking that we can do this. I also want to thank the Manhattan Institute staff that always pulls these conferences off seamlessly for us. Dean also for being such a great partner in making things progress through the whole process. The Smith Richardson Foundation, I don't want us to forget, the money that made this all possible, largely, not entirely, Manhattan Institute also supported us, but most of it came from them, and we thank them. The Journal of Financial Intermediation and their very wise editorial staff, yes, that's a joke, that decided, because, you know, without that, some of you who aren't academics don't understand, but if we didn't have published Referee Journal standing behind all this, it would be very hard to inspire authors to be taking this as seriously as they did. And then finally, Melina Robana, who's at the Program for Financial Studies, and the supporters of the Program for Financial Studies that have also made this possible. So it's really, as you can see, a team effort, and I'm very appreciative. So thank you all very much.